Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, May 4th, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in areas we feel offer the best prospects for growth instead of trying to time the market. We focus exclusively on the traditional investments of stocks, bonds, and cash, so we analyze fluctuations in the stock market as well as interest rates to help drive our overall investment process. We'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. And over the past 2 weeks, we saw the stock market go up about 1.46%, which gives us a year-to-date gain of 5.62%. Next, we'll look at interest rates as issued by bonds, as measured by bonds issued through the U.S. Treasury Department. We believe interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, especially stock valuation calculations as well. Generally speaking, lower interest rates will help lead to higher stock prices, and higher interest rates will lead to lower stock prices. Over the past month, we saw interest rates rise slightly. So we've got interest rates listed over here on the left-hand side. We've got maturity lengths listed on the bottom axis. The brown line is where we were a month ago, and the green line is where we were as of Friday, May 1st. So you can see 8 basis points is the largest move here for the 2 and 3 year U.S. Treasury, and that's really not a very significant move. We have seen evidence to suggest that the 2 year U.S. Treasury is the most correlated with the interest rates that are set by the Federal Reserve. So we do keep an eye on that, and seeing that raise could potentially be indicative of where the Federal Reserve rate will potentially go. If we look just at the 10-year U.S. Treasury, because so much is tied to the 10-year rate, we can see that it was pretty low here right before the Iran conflict. It increased to about 4.43% at the end of March. We got that ceasefire agreement at the end of March, which led to some lower interest rates, but then the Strait of Hormuz was fully open until it wasn't, and the U.S. blockade remained in place, and interest rates have crept back up. It got up to about 4.43 again before pulling back here the last couple of days. So the question is, does this become a ceiling now that we've reached this 4.43% twice in the last couple of months? Does that serve as a ceiling that maybe we're not going to break through? Maybe we will continue a downtrend that would be helpful for a lot of reasons. Time will tell whether or not that comes to pass. We do like to look at the corporate bond yield spreads. This is a measure of how much more a corporation is paying on interest as opposed to the U.S. Treasury bonds. And so we can see here before the war started, the spread or the difference in interest rates was really low. We saw a significant increase, which potentially suggests a higher probability of default for these corporations that are financing operations with debt offering. But once that ceasefire agreement got in place, we've really seen people buying, investing, potentially most likely buying these high yield instruments that were paying that higher interest rate. And now we're seeing those interest rates coming lower, or sorry, the spread coming lower. Really, like we're lower now on the spreads for these corporate bonds than we were before the war even started. So that's a very, very interesting move in that area of the market. The Federal Reserve did have their meeting, but they do every 6 weeks, and left interest rates unchanged. This is the last one that Jerome Powell is the chairman of the Federal Reserve. He has decided to remain on as a board member. for an indefinite period of time. His term will end as a board governor within the next couple of years, but at least for the time being, he's planning to stay on. Uh, we could speculate some things there, but we'll leave it at that. Kevin Warsh is the next Federal Reserve chairman to come on. He's already made it through one subcommittee. He needs to go for a full vote, which should happen over the next 1 or 2 weeks, and then take his place as chairman on May 15th. If we move on to the Strait of Hormuz, again, we had some nice activity going on through the strait. No problems until we start shooting missiles, and then the strait effectively closed. We did get a ceasefire, and we did have a full opening as some suggested, but just kidding. We have a blockade, and the blockade remains in place, and the strait is effectively closed. For oil prices, we saw an initial spike here. Even post ceasefire, we still had a couple days where we saw the price of oil continue to climb. We did again. We reopened the Strait of Hormuz fully and completely. Oh, just kidding. We are going to maintain the blockade, and so we see oil coming back up. So not quite where we were a month ago, but still elevated levels. And just this could potentially be the start of a downtrend, right? A higher point. Now we've got a high point, another peak that's not quite as high as the last one. Too early to tell for sure, but this would be really nice if this was setting a ceiling as well when we're going to start going back to pre-war levels. The difference that is probably the biggest and most impactful for us here in the United States, and for people like you and me, is the retail gas prices are surging. 2 weeks ago, we thought we were firmly in this downtrend and we were going to be guzzling gas once we got to Memorial Day and started our summer vacations, and we have seen a complete reversal in gas prices to the highest levels that we have seen since 2022. If we take a 5-year chart, we got up just above $5 a gallon back here in the summer of 2022, just after Memorial Day, and then we saw them come down. We would hope that we would see something similar. Could we get back up to $5 a gallon? Yes, we could. Could we go beyond that? Yes, we could. We're hopeful that it doesn't get to that, but I mean, it could happen. We're hopeful that this eventually soon will peak and start coming back down. But with the summer driving season starting in 3 weeks, and the trajectory of this chart, we saw some pretty straight lines going straight up back in 2022. So it's not outside the realm of possibility for that to happen again. Hopefully that doesn't happen, but um, that's kind of where we are for now. Okay, so we've covered a lot of the recent developments in our review of the markets. Some of the other things that we wanted to point out, there are many reasons why we think President Trump should end this conflict in Iran. He's already expired the 60 days of war powers, even though he claims that the war is over or the conflict is over. The blockade is something different. Um, it's also interesting because we can see how the global oil market is being disrupted through this war and this blockade. We did have an announcement by United Arab Emirates that they are going to leave OPEC, which is the organization of the petroleum exporting countries, mostly Middle Eastern countries. And since 1960, they've basically been running the show. And just very interesting. We had Venezuela conflict that was relatively quick a few months ago, and they're an oil producer, an oil exporter. We've got this oil disruption happening in the Middle East, and so it's again still probably too early to know for sure how this is going to end, but there are things happening that this could have some reverberations throughout the global oil market. So we'll have to keep a close eye on all of that. Um, but anyway, lots of reasons to end the war quickly. We've also noticed that there are continued issues in the travel industry. We know that there were a lot of flights and international flights that were canceled in the Middle East, right? We still have jet fuel shortages that are causing flight issues. Spirit Airlines is now gone. They're shutting their doors this weekend. But at the same time, we're also seeing reports that we've got companies that are doing flying taxis in New York City or testing those out. So, um, very interesting things that are happening in our world and our country. So, um, April was the best 1 month performance in the stock market since 2020, since the COVID pandemic. And it's just very interesting to see, despite the war, despite this blockade and this disruption to the global oil market and surging gasoline prices, the stock market has marched to all-time highs. Our economy still seems to be fine. The first quarter GDP came in at 2%, which isn't gangbusters, but that's solid growth. Um, we are seeing first quarter earnings from the Magnificent Seven that are mostly good, and the other 500 companies, again, mostly good. Around 78 to 80% of these companies are beating the expectations that analysts have for their revenue and their earnings. We're hearing announcements of trillions, multiple trillions of dollars being spent on AI infrastructure. So, by and large, in aggregate, Americans are still employed. They are still increasing their wages. They're still they've got demand for goods and services. They're spending their money, and as long as they don't have to keep spending more on gas and they can spend it on other things, things should continue to move along just fine. Consumption makes up 2/3 of the GDP. Business investment, obviously still continuing, makes up another big percentage of the GDP. So as long as those two categories are spending money, our economy is going to continue to grow. So um, we're still optimistic that despite everything going on in the Middle East and the Strait of Hormuz, things are still working out here. And again, this is why we stay invested. This is why we might slightly modify strategies and rebalance and try to be a little bit cautious when we feel like we need to be. But this is why we don't want to go to cash, because the reversal we saw from how horrible things were in March to how fantastic things were in April, we just wouldn't have been able to act fast enough if we had gotten completely out and tried to get everybody back in. Um, so we're happy with how things worked out, and feel like we're still in a good position to see which way things go here in the month of May. All right, as a final word, this article dropped in our inbox this week. It's called The Biggest Myth in Retirement That You Need to Save $1 Million. So, right, we see this question get asked and answered all the time in opinion sections. And so, how much do you need to retire? Well, it's going to be a different answer for everybody. But we think that when these surveys are conducted and people give us a number of 1.1 or 1.3 or 1.5 million. It's kind of an arbitrary number, and there's really no way to know for sure. And our approach here at Diamondback Financial has more to do with cash flow and making sure that we're providing you with an income to, at the very least, meet the monthly expenses and ideally exceed the monthly expenses so that you don't feel like you're going to run out of money. We've got individuals who have investment accounts and they're using some of that for income. Everybody should be receiving Social Security in some form by the time they retire, even if the benefits are reduced because of insolvency and changes that are going to have to happen with the Social Security program. There will still be something that the government is providing. Um, Others will have pensions, some will have annuities, and some will receive inheritance from parents or other individuals. Lots of people will invest in real estate, or they'll be business owners and they'll have cash flow that they can draw from a business. So what we try to take the approach of how much money do you need, and what's the number that is going to make you feel the most comfortable? Is it 5,000 a month? Is it 10,000 a month? And again, everybody's going to be a little bit different. And then once we've identified what the number is, we can backtrack and say, okay, here's what you're going to need from all these different sources. And having multiple sources of income is also a good thing too, because you're diversifying those income streams. And if we have a bad month in or a bad year in the stock market, we're not relying on a declining asset. And if we've got vacancy in our real estate property, then we're not going to be completely pinched because of that as well. So um, ideally, we're trying to give you peace of mind. We're able to pull that from a lot of different places, and diversifying that strategy is always a good thing. But if you have questions, if you want to have this conversation and try to figure out what that's going to look like for you, we're happy to have that conversation. We're continuing to reach out throughout the year to do annual reviews, and this is part of what we can talk about. But you're always welcome to reach out to us if you want to talk about it in the meantime. So we thank you again for working with us and giving us your time and attention, and hope to see you soon, and hope you guys have a good week.